is the financing section. This involves our long-term liabilities and our stockholders' equity accounts. It's going to involve the financing section and a little bit in the operating. Okay, so we look at our notes, our additional information, and it tells us that net income for the period was $28,000. So, net income increases our retained earnings. So we would go $28,000 there. And then we have the spot in the operating section for net income as the first item. So we put that there. Other items that pertain to this, there's nothing much more. Oh, cash dividends declared and paid of 23. That reduces our retained earnings. And as a financing activity, we simply say we paid dividends. Okay, and the dividends were the 23. It makes sense that if it's a debit up there to reduce retained earnings, it'll be a credit down here to indicate that cash went out. Okay, the next thing that happens is they don't give us anything more in the notes, but what we have to do is to make sure that nothing else happened. And it looks as though we also, when we're going to check our accounts, the bonds payable went from 10 to 20. So we're going to have to assume, since nothing else is said, that we must have issued some bonds. Okay, because we had 10 plus 10 would give us 20. And so we would have to say we issued some bonds payable. Okay, and it's a credit up above. There would be a debit down here, which makes sense because we got the cash. Okay, so that's all of the financing activities. We just double check now this adds across. The nothing happened with the common stock. The 28 plus the 28 minus the 33 minus the 23 should give us the ending balance. And that looks like that's it for the financing section. Okay.